Well, hi guys, welcome to this Money Control live stream. It's a Tuesday morning and you're watching Morning Trade with me, Nandita Khemka. Well, the global cues coming out of, this morning are fairly mixed, given the fact that the Wall Street has snapped out of a 4-day losing streak, but the Gift Nifty hinting at a muted to subdued start for the Indian markets. Over the next 30 minutes, we'll be talking about the cues for trade, all the stocks in focus, and of course, we'll also be taking up all your stock-related queries. So if you have any queries, send them in to us on our YouTube feed, and we will have them addressed by a technical expert on the show. But before we go any further, let's take a look at the top headlines at this hour. Wall Street shrugs off concerns over rising bond yields to snap a 4-day losing streak, although indices remain on track to end September with losses. Bond yields, however, hover around the levels last seen in 2007. Asian markets open lower despite a positive handover from US peers, Gift Nifty hinting at a flat to subdued start for the Indian market. Among stocks in focus today, Moody's upgrades Tata Steel to investment grade and changes the outlook from positive to stable, anticipating improvement in profit amidst its efforts to reduce debt. Also in the spotlight will be Strides Pharma and Wellspun Corp. SEBI announces T2T ASM surveillance to curb speculative activity in SME stocks. Move is aimed at curbing speculation amid rising retail participation in the space. AIA-DMK snaps ties with BJP. The decision to sever ties with stems from a series of issues, including disagreements over alliance dynamics, allegations of interference, and unpopularity of the alliance. Well, let me first bring on board our technical expert for today, Sacchitanand Uttekar of TradeBulls Securities joining in this morning. Good morning, Sacchitanand. As usual, great to have you on the show. But given the kind of volatile setup that we've seen in the markets yesterday, after 4 days of losses, the Nifty did manage to end in the positive zone. But given the kind of volatility in the markets, what should one's F&O strategy be for tomorrow, for today rather, on the index? And where would you see crucial support levels emerge for the Nifty going forward?
Good morning, Nandita, and thank you for having me on the show. Clearly, if you look at the last 5 trading sessions, Nifty has shown a very sharp decline of almost 3%. But I think yesterday's session was very crucial. Yesterday, we saw some stability coming back into the markets, especially if you look at the 60 minutes data. When we look at the Nifty RSI, there are early signs of a positive divergence, which has been evident on the 60-minute scale. On the daily scale, we saw a doji kind of formation. Now again, doji as a candlestick pattern indicates indecisiveness. But after a decline of almost 4 trading sessions, the occurrence of a doji is a promising sign that probably we may see some stability coming in the market soon, and there could be a reversal in sight. Now, if you look at the last 5 trading sessions as well, we saw a gap sequence which has been ongoing. The entire structure started with a breakaway gap at 20,100 when Nifty breached that very consistent higher top higher bottom sequence, and after that we saw a runaway gap somewhere close to around 19,900. Now that particular level was also a very key support. Now there's a good probability that we may see an exhaustion gap soon, and that's why we are of the opinion that the sell on rise strategy should be avoided, and from here on every declines could be an opportunity to get it back into the market. So from a trading perspective, for today's session, I think 19,540 would be a crucial support on the lower side. Until unless Nifty is holding above this particular support, I think that the decline could be an opportunity to accumulate some good longs. On the lower side, we don't see any further slippages below the 19,500 mark for this particular expiry. On the higher side, for today's session, 19,780 remains a very crucial resistance because the 20-day exponential moving average is also placed there. So in case if we see a rebound during the session, we may see some profit booking near to this particular zone of around 19,760, 780. So probably we may see Nifty oscillating within this range of 19,540 on the lower side and 19,750 on the higher side. When we look at Nifty Bank, again here it's a very similar structure, but relatively I think Nifty Bank looks better. From a trading perspective, 45,000 remains a very crucial hurdle until unless we don't see it for closing firm above this particular level. We may not see any fresh directional momentum play. But on the lower side, the support at 44,500 also looks promising. So I think the next strategy for the day is to accumulate Nifty and avoid the sell on rise mode, which has been there for the last few trading sessions. So on a declines, we are of the opinion that the Nifty can be traded on the long side, keeping a stop loss somewhere close to around 19,540 on a closing basis.
All right, so buy and dips is on the strategy, and we'll talk about specific stocks, banking stocks, when we come back and, talk about specific stocks. Of course, HDFC Bank has snapped out of its losing streak, so we'll be talking about that as well, Sacchitanand. But, before that, let me also bring on board my next guest for today. Joining me is Dhiraj Relli, who's the MD and CEO of HDFC Securities. Good morning, Dhiraj. Great to have you on the show. First of all, I want to ask you, equity markets have turned fairly volatile after hitting fresh records. What's your view on where we are headed next from here? And, what should one's asset allocation strategy be? Would you say that one should increase the exposure to debt, given the fact that, we've seen Indian bonds being included in the JPM EM bond index? So that has come as a boost. So would you say that it's time to increase exposure to debt?
Good morning. First of all, markets, I think the near-term trend is bearish in the market, but long-term or mid-term trend remains positive in the market. We've seen the data of pre-election year and post-election year, markets remain more volatile, but largely they remain positive only. So we believe that after a near-term correction, markets will get back to again positive, and markets will continue to do well. We have a stock-specific opportunities in the market. I think that's what investors should look at. And coming back to your question on asset allocation, I think asset allocation always is a good strategy, and it's an individual choice. Currently, investing in debt is a tactical move. One should do that, because a small portion of the investment can go as a tactical investment in debt. Currently, we are almost at the fag end of the interest rate increases, maybe another 25 basis increase by Fed, or maybe at best one more increase in India is possible. But beyond that, we've seen that interest rates have already peaked. And with the inclusion of Indian bonds in the index, I believe that we will head for a lower interest rates. So that way it makes sense to have a tactical allocation in the debt as well.
All right, Dhiraj, there is a lot of momentum in the IPO markets. Would you advise caution, given the fact that some of them have seen a spectacular listing, but some of them have really turned out to be lukewarm? So in the face of retail interest in IPOs, would you suggest caution when you look at the primary markets right now?
See, this year primary markets have been good. Other than the 2-3 negative listing, most of the stocks have listed positive. Last year and in last couple of years, we've seen a lot of platform companies, new age companies getting listed, and that's where we saw some kind of a correction, significant correction post listing. But after that, I think merchant bankers as well as promoters are a bit more cautious, and we've seen more of our traditional businesses getting listed this year. So to that extent, it is all right for investors to continue to invest in the IPOs. But, any given IPO has to be evaluated on its merits only, and not on the basis of euphoria. If you find there are good companies backed by a good business model and good fundamentals, definitely it's a good route for retail investors to start investing in capital markets.
Right. I also want to ask you, how do you expect the brokerage industry to pan out in the rest of the financial year, given the fact that we have seen a retail rush, there's been a explosion when it comes to the creation of new demat accounts as well. FY24, how do you expect it to pan out for the brokerage industry in particular?
FY24 will be very good for the broking industry at large. We've seen significant increase in the volume in last 5 months in cash segment as well as in future and options. So we've seen a buoyancy in terms of volume and activity, and also we are adding more and more customers. So a lot of new customers are signing up and getting active, and they are interested more and more investing into direct equity. At the same time, we have also seen investors using mutual fund route also to participate in the capital market. From that point of view, I think from both brokerage as well as distribution income point of view, it is going to be a very good year for the broking firms.
Lastly, Dhiraj, you're taking on the likes of Zerodha and grow with the launch of Sky, right? So how do you expect to, expand your client base, and what sets you apart from these players in the market?
See, we very recently launched HDFC Sky. It's a new age, cutting edge platform. It's a multi-asset platform. Customers can transact in equity, derivatives, currency, commodities, ETF, mutual funds, and also global assets through one single platform. How do we stand out? We also bring in our 23 years expertise of research, and that too, our in-house research is completely free on our platform. And we also offer margin trade facility at 12% per annum, which can help customers to take higher stakes in the market by taking some leverage.
All right, Dhiraj, with that, running out of time. Thanks a lot for taking out time and joining in this morning. We look forward to touching base with you once again and, taking this conversation forward.
Thank you.
Well, with that, let me get back to Sacchitanand and talk about HDFC Bank. As I had indicated before I got the next guest on the show, HDFC Bank, after hefty losses last week, Sacchitanand, it has managed to snap out of the losing streak, even though it was fairly volatile yesterday. Do you think, or do you see a trend reversal now, or do you think, it will be, under pressure going forward as well?
Nandita, I think there's a good possibility that we may see a change in trend again from here on. If you look at the data from November 2022, we can clearly see a broadening formation getting shaped. And if you look at this particular formation, the base of this particular formation is placed somewhere close to around 1500, 1540 kind of a zone. So even yesterday, we saw a very confident price action here. The short covering was very evident. And after a very severe decline, there is some stability which has been displayed, at least on the, when we look at the daily RSI. Now, on the daily RSI as well, we have a positive divergence getting shaped up. And probably, a swing above 1560 from here on could be a confirmation of this particular, reversal. So as of now, I think it's a good zone wherein the stock can be accumulated even from a portfolio perspective. Stop losses can be kept somewhere close to around 1490 on a closing basis. And any declines towards 1500, should be utilized to even create positional longs. So from here on, I think clearly there is a good amount of evidence of a clear-cut support, and probably again, third time we may see this particular support, getting respected, and probably we may see a reversal soon. So from a trading perspective, 1560 would be my target, but eventually, in case if we see a very firm sustained move above 1560, there's a good chance that the stock may rebound back to around 1600, 1660 levels very soon.
All right, that's the view on HDFC Bank. But let's talk about Tata Steel now, given the fact that it is the stock of the day. For me, Moody's has upgraded the stock to investment grade. In fact, it has changed its outlook as well from positive to stable. It expects better profitability despite softer steel prices and the focus on debt reduction as well. Tata Steel, I think over the last 1 month and in fact, even on a 6-month basis has done fairly well. Last 5 sessions or thereabouts, it has seen some bit of a cool off. But going forward, what are the support levels you're working with here, and any kind of resistance levels on the upside to watch out for?
125 is a very important support in case if we see the stock again slipping below the same. The move may extend towards 120, 122 kind of a zone. And on the higher side, 130 remains as a very crucial resistance. So probably, we may not see an immediate reversal here, but the stock may, keep oscillating within this particular range. So 130 on the higher side and 125 on the lower side would be the expected range for the day.
All right, those are the levels to watch out for on Tata Steel. But let's talk about Eicher Motors, given the fact that there is a brokerage report on the stock. Jefferies has raised the target price to 4,150 rupees per share. It has a buy rating, and it says that the rising competitive concerns have been there. They've been weighing down on the company in 2023, but channel checks are suggesting that the impact on the company hasn't been all that great. Of intensifying competition, and the stock has lagged the auto index by somewhere around 24%. On a YTD basis, but Jefferies believes that it is a good time to buy into the stock, given the fact that competition concerns have alleviated for the company, because it has hasn't really had that much of an impact that the street was actually anticipating. EBITDA and EPS estimates are expected to rise 62% and 81% over FY23 to FY26. On the charts, Eicher Motors, of course, it did come under a bit of cloud, once we saw launches from Bajaj Auto as well as Hero Moto. But given the fact that we have a bullish report coming in, do you think the sentiment will revive going forward for Eicher Motors?
Well, the stock has been a relative underperformer, and clearly, if you look at last 8 weeks, the stock has not gone anywhere. Even right now, the data is not supporting a very strong up move. The option writing activity has been very confident at 3450, 3500 kind of a zone. So we don't see that particular level getting breached, in a day or so. And probably on the lower side, it has been trying to maintain and sustain above that 200-day exponential moving average, which is placed at around 3300. So probably 3300 could be an important support going forward. But as of now, the trend looks more consolidative than very strong, and probably in case 3300 is breached, we may see one more round of weakness here. So I would rather buy this particular counter on a breakout above 3500 and avoid accumulating this particular stock on declines.
All right, that's the view, buy on declines coming in on Eicher Motors. But let's talk about, Strides Pharma before I take up some viewer queries with you, Sacchitanand. Strides Pharma was up 8% yesterday on the back of, US FDA nod for one of its drugs. But, post markets, there was news that the company will be spinning off CDMO gelatin businesses into a separate unit. This unit will be called OneSource and will be listed over the next 12 to 16 months. And shareholders will be getting 1 share of OneSource for every 2 shares held in Strides. And OneSource is expected to deliver revenues to the tune of $180 to $200 million in FY25. 8% rally, already played out on Strides yesterday. Would you say that there could be a sell-on news today and perhaps, the stock will cool off a little bit? Or do you think it is going to, continue the momentum and perhaps, look at moving higher in today's session?
Well, the trend strength is looking good. In fact, we saw a breakout from its cup and handle formation at around 500 levels. So I think 500 remains a very stable and a confident support zone. So even if we see declines coming here, I think that decline would be absorbed. And on the higher side, the entire pattern and the trend structure is indicating a price swing towards 670. So eventually we may see a further rally in this particular stock. So the advice would be, to accumulate and ride on this particular move, keeping a stop loss somewhere close to around 485 on a closing basis. Any declines towards 500, 510 would be a good opportunity to, add on to long positions. There is no sign of any divergence here on its weekly and daily scale. So probably, we may see this particular momentum getting carried forward even in today's session.
All right, expect the momentum to continue Strides Pharma. But let's take up some viewer queries then. Let me start with a query on the sugar pack. We have a query coming in from Mahendra on Dwarikesh Sugar. Sugar stocks were high flyers in yesterday's session. Of course, sugar prices globally are at 12-year highs, and there are, concerns over output back home, which is why prices could move higher from here, and sugar firms will be beneficiaries of that. And, we saw a rally of somewhere around 8 to 10% coming in on some of these sugar companies. But particularly for Dwarikesh Sugar, what should one do?
Finally, I think the stock is displaying some strength. It has managed to, register a close about that 105 mark. And we have seen sustained, buying coming there. So probably, it's a good time to chase momentum here. Keeping a stop loss somewhere close to around 98 on a closing basis, the stock can be accumulated even from a portfolio perspective. The immediate swing could be witnessed somewhere close to around 117. So I think the stock can be accumulated here. Even if we see momentum, I think momentum can be chased for a immediate swing towards 170.
All right, hope that answers your query on Dwarikesh. You should chase the momentum on this stock. But let me take up a query on Graphite India. This one is coming in from K. Naga. This stock has done particularly well on a 6-month basis, up somewhere around 90% or thereabouts, Sacchitanand. It's still some time or some levels of some points away from its 52-week high. If somebody is invested in this stock, should they look to book out on every rally, or should they hold on, or how should they approach this now?
So as of now, the stock is holding itself well above its 5-week exponential moving average. So now this particular average is currently placed somewhere close to around 482. So unless we don't see a sustained closing below the same, I think it's a good idea to maintain the bullish bias. Retain your longs with a stop loss at around 470. The moment it starts slipping below 480, 485 kind of a zone, and then probably some profits can be booked. But overall, if you look at the broader structure, there is no major weakness. On the lower side, we recently saw a very strong positive crossover on its 5 and 20-month exponential moving average. We have the ADX on the monthly scale, trending confidently above that 25 mark. So, we don't see any major weakness in this particular counter, and there is a good possibility that this particular trend could continue on the higher side. We may see levels close to around 580 to 600 in a month or so.
All right, that's the view on Graphite India. Let's take up a query on CDSL next. Ashish Kumar wants to know your thoughts on CDSL and HDFC Bank. We've already discussed. CDSL, I think in the last 1 month has given double-digit returns. 6 months as well, solid 40% up move coming in. What is the long-term view on this stock now, Sacchitanand?
Well, from a long-term perspective, we still feel that there is a good possibility that the stock could swing towards 1800. The base right now, which was formed at around 1000 levels, I think that particular base has given us that confidence. And on the higher side, we recently saw a fresh breakout from a cup and handle formation at around 1250. So any declines towards 1250 could be a good opportunity to accumulate the counter. The stop loss from a trend perspective can be kept at around 1080. And declines, should be utilized to create some long positions. But the structure here is indicating that eventually, if you keep a time frame of 12 to 18 months, we may see this particular counter swinging towards 1800.
All right, 1800 is the kind of level that is possible on the charts. But let's take up a query on Sun Pharma. Marcus wants to know your thoughts on this stock. Sun Pharma over the last 1 month at least hasn't really done much. Sacchitanand. But over the last 6 months or thereabouts, it has gained somewhere around 14% or so. It's still not very far from 52-week highs. Would you say it's the time to buy into any kind of dips on this stock?
Nandita, last week also we were very cautious when it came to Nifty Pharma and most of the pharma stocks. And even here, when we look at Sun Pharma, the 1160, 1200, 1160, 1180 zone looks very difficult. On the higher side, we are expecting that this particular price move that we have seen so far could be an early sign of a double top formation. The recent correction or the drop that we have seen from 1160 levels seems very incomplete, and probably we may see this particular stock sliding further towards 1100 levels. So as of now, I think I would rather avoid buying these dips and probably check at the structure once the stock starts trending around 1100 levels.
All right, that's the view, a cautious view coming in on Sun Pharma. But last query for today, we are running out of time, so just squeezing in one more query now. Jafar Raza wants to know your thoughts on Tata Consumer for the long term. Yesterday it was among the top gainers on the Nifty 3% uptick or thereabouts. How would you advise investors to look at this stock for the long term now?
Well, Nandita, I think this is one of our top picks for today. In fact, yesterday we saw this particular stock, giving a very confident breakout above its 900 level. Now, this particular level is very important because from a weekly and monthly perspective, the stock was not managing to sustain above that 900 mark since September 2021. Now, this is the first time that we have seen a very firm breakout here and a sustained move. The pattern structure is very confident. It's a continuation flag formation. From a long-term perspective, we may see this particular stock, scaling towards 990 levels. But from a trading perspective, we have a target of around 930 that we are recommended, keeping a stop loss somewhere close to around 890. Even traders can accumulate this particular counter. The second stock on our radar has been Ultratech Cement. After 5 straight days of decline, we have seen a doji kind of formation at a very important support level at around 8,200. So keeping a stop loss somewhere close to around 8,150, we may see a very strong reversal getting shaped up here. So we are expecting a swing target of around 8,450, and Ultratech Cement can also be accumulated on a decline, keeping a stop loss at around 8,150. And the final call would be a sell call on ICICI Lombard. Yesterday, we saw the stock slipping below its 20-day exponential moving average. There's a negative crossover on its short-term averages. The data is indicating that the stock may slide towards its 200-day exponential moving average, which is placed somewhere close to around 1265. So keeping that target in mind, the stop loss should be placed at around 1345, and fresh short positions can still be added in ICICI Lombard.
All right, Tata Consumer, Ultratech Cement, as well as ICICI Lombard. These are some of the stock recommendations coming in from Sacchitanand. With that, Sacchitanand, thanks a lot for taking our time and joining in and sharing your thoughts, and of course also addressing all of your queries so patiently.
Thank you.
Well, with that, we've come to the end of this edition of Morning Trade. So from me and the entire team, thanks a lot for tuning in, but don't go anywhere because coming up next is Opening Bell.